Hello again, friends. What is volatility in stocks? When we talk about volatility, we're talking about how much a stock fluctuates, right? Does it move a lot? Does it move a little? Did you know that you can calculate that down? There are tools that will show you the exact level of volatility, things like beta, things like standard deviation. We're going to explore those today. And certainly if you're going to trade options, you need to understand how volatility works because that is a big part of option trading. So let's have some fun. So when we talk about what is volatility in stocks, we're talking about beta. And as you can see, let me zoom in here. As you look at the beta for a certain stock, see if we can get that zoomed in. There we go. So beta past 5 years for, this is Colgate Palmolive. Now Colgate, that's toothpaste, right? That is consumer staples, things that you buy no matter what the economy is doing, you need your toothpaste. Well, that's a very low beta number. So the S&P 500 has a 1 beta, 1.00. It's the baseline, it's your average. Anything below 1 is low volatility, and here you can see that Colgate has very, very low volatility, less than half the volatility or daily fluctuations that the S&P has. So if the S&P 500 moves, let's say 2% on the day, Colgate is probably going to move a little less than 1%. It's just a low beta stock. Now, if we look at a wild and crazy stock, maybe Tesla, if we look at Tesla, which has a lot of, it's a growth company, it has prospects for the future, but it has risks in terms of its valuations and so on. Now all of a sudden, you're well above market average. This is more than 2 times the volatility of the stock market. So notice the difference here. We've got Colgate, which is slow and stable and just kind of, I don't know if I'd call it boring, but definitely much slower pace, whereas Tesla has a high level of volatility. Now, there's other ways that we can measure this out. And so in terms of measuring it out, think of it in these terms. How much does the stock fluctuate? If you had 2 companies, let's say company A and company B, and they were both trading at $100 per share, okay? Pretty standard. Well, the way that these companies, the way that their options are priced is based on the volatility of the past. So there's something called historical volatility, and that's measurable, right? We can calculate down to the penny how volatile something has been. And let's say that its historical volatility is 20%. Well, there's something else called implied volatility. And implied volatility doesn't have to match up perfectly with historical, but it will usually be somewhat similar because using the past is a pretty good representation of what to expect in the future, right? So the future volatility, maybe they're expecting a little bit more volatility, so it's at 25%. Now we could say, okay, the A, we know the market is expecting more volatility out of the stock than the past, and B, maybe they're right, maybe they're wrong, but it's a little expensive compared to its historical. What this implies is that this company that's at $100 per share, it has bands, it has expectations. And basically, over the past year, it experienced 20% volatility. So maybe it traded in a range between, let's say, $80 per share and $120 per share, right? Which would be about 20% of 100. It's about 20 bucks, right? So that's where it was, but it's expected to move in a band between about 75 to 125 in the next year. That's the way the option market is pricing it, seems to be expecting a little bit more volatility. It's measurable, it's calculable, and we can see exactly what the past has been and what the future is expected to be. Now, if we come over here and look at stock B, they might be entirely different numbers. Now, notice the difference here. Maybe the historical volatility, I'll just call it historical vol, maybe for this company, it's at 50%. But maybe the implied is expected to die down a little bit, and maybe the implied is now at 45. So in other words, still a $100 per share stock, but as we look at its expected volatility, we can say, okay, what it did in the past was a lot of volatility. It traded in a band between $50 and $150 per share, right? That's how wild and crazy it was in historical terms. But the implied is different than that. The implied is saying we expect it to quiet down. We think that a lot of the bumps in the road, have calmed. And so now it's expected to still be volatile. Clearly a lot more volatility expected than over here, right? This could be a very slow moving stock like Colgate or whatnot. And Colgate, frankly, is even pricing in less than 20% type. When you got a 40 beta, that stock is expected to move very, very slowly and in a tight range. Here, we've got a stock like Nvidia or Tesla or something that is just much more volatile. And so the expectations and the bands and the option pricing and all of that factor that in. And so volatility and volatility studies are very, very important because it gives you a framework. It gives you an expectation. And this is crucial for you being successful as a trader and investor, is to understand what's normal, what's abnormal. Because if we can answer that question, now we know when the market has moved into an abnormal state. If the S&P 500 is pricing in 20% volatility, and that's the norm, but we've already moved 25, 30, we know that, hey, something abnormal, irregular is happening in the stock market. This is where the probability and the odds of a crash and really getting, wild and price moves and so on increase, because as you move more than the expectation, what happens is those that know, they understand that things are acting in an abnormal state, they go into hedging mode. Now what hedging is basically protecting yourself. And it's a beautiful, beautiful thing, because now all of a sudden, if I hedge up, as the market keeps crashing lower, sure, my stocks are going down that I own, but my hedges are going up in value, and thus I'm staying more flat. So while everyone else is experiencing the pain, I'm making money from my hedges to offset the risk in the portfolio. And these are smart things that we can do when volatility is moving outside of norms and outside of expected ranges. So volatility studies, huge part of what professional trading is all about. Now, I'm going to point you to this next video, which is what is a good stock to invest in. Now remember, volatility matches with what type of company it is. Growth stocks tend to have more volatility. Value stocks tend to have lower levels of volatility. So this fits hand in hand. Make sure you watch this video. Click the link right here. Find what is a good stock to invest in. Make sure you hit that subscribe button. Click the bell to be notified. Share this video with friends and family. Have a fun time learning. We'll see you next time.